So, the federal government, in a failing attempt to fool young Canadians into voting for them again sometime soon, recently announced a few major changes to home financing that are supposed to make the younger generation feel like they have a better chance of getting into the market. And I'm sure by now, every other Canadian YouTube channel has put it out there on their thoughts of why the Canadian government sucks. And I guess on the other hand, every TikTok and Instagram agent is praising why this is such a good thing and why you should buy right now. But the truth about these new announcements actually lies somewhere in the middle, because one of the two announcements they made this last week is actually pretty good, and the other is going to lead to further unaffordability and add to the ever increasing real estate prices and debt loads for the next generation of homebuyers. And I'm a realtor, so it benefits me if more people can buy homes. And I truly believe that home ownership should be one of your top three life achievements, behind getting married and having a successful relationship and having kids and raising them to be productive members of society. So if you would like more market insight from someone with those values, please subscribe to the channel and go ahead and click the like button for being a responsible adult. And if you're considering buying a home, or you just want to learn more about what you should know, you can download my Informed Buyer's Guide right now using the link in the description below this video. Now, let's touch on the changes the government made this week, starting off with the terrible move of increasing CMHC insured mortgages, which are government-backed loans, to a total purchase price of $1.5 million. You see, before this change, if you had a home worth $1 million or more, the government would not back your loan with CMHC insurance. So depending on your purchase price below that amount, you'd have to put down somewhere between 5 and 10% as your down payment. And if you wanted to buy a $1 million home or more, you would have to come up with a 20% down payment, meaning that the most that they would ever insure with a government-backed loan was a maximum of about $925,000. If, of course, you were buying that home as high as $999,999. But now it appears that you will be able to take on something like a $1.375 million mortgage and still have it insured. And that means you'll only need to come up with $125,000 as a down payment if you're purchasing a home at $1.5 million, when before that down payment had to be $300,000. So why do I think this is so bad? Well, first, let's point out the obvious. If these homeowners start to default on these monster loans, who's on the hook for those losses? Well, it's you and me as Canadian taxpayers. We are backing these loans. But also, it's a stupid move because we're encouraging people to just keep on taking on more and more debt rather than building more homes or slowing down immigration. Because that's exactly how the government fixes things. They just sell out the future for fixes now. And apparently, they think you should do the same. Now, ask yourself these questions. 1, do you think it's smart that if someone's buying a $1.5 million asset, that it's too much to ask that they have a little skin in the game? Is it too much to ask that they put 20% down? And 2, are the people that can afford a $1.375 million mortgage, that, by the way, is about a $7,642 a month payment at today's rates, are they the ones that really need the government's help in order to get into the market? Or should the government be focused on the people that are struggling to buy just their first small home out in the country or that tiny little one-bedroom condo in the city? Well, that actually brings us to our second announcement, which for once is something that I don't think the government screwed up. I think this is the first time I've ever said that. And that is extending 30-year mortgages to all first-time buyers, and that's up from the previous 25-year limit. Now, I'm definitely not in favor of giving some benefits to certain citizens that other citizens don't have. But at the same time, I do think that if you're going to do that, and it appears that that is the way our society is headed, then yes, you should give that break to those just starting out so that they can also get their foot in the door. And so then when they move on to their second property, well, they can just fall in line with everybody else. But I don't think 30-year amortizations are a bad thing, specifically not bad for younger people. First off, that's because they got a lot of time to pay down these mortgages over the coming years. And, well, Older folks that have had the means have had access to 30-year loans for a long, long time. And let's face it, they have less time to pay back those loans just because of how much time they have left. Second, these young folks buying into the market now are going to increase their pay over the years as they gain seniority in their jobs and increase their skills. So, as time goes on and their mortgages start to get paid down, they can probably also do lump sum payments or choose to increase their biweekly or monthly payments in the future to pay down their mortgages faster. And third, let's face it, your first place is likely not your last place. Almost every first time home buyer becomes a second time home buyer. And when they get into their second place, they can either amortize out again over 30 years if they've been good little savers and saved up that 20% in order to do so, or they can be moved into a 25-year product when they upsize. So I'm in favor of this move as a whole, except for one small detail in the fine print. Because this new policy is for first time home buyers. And in my mind, that should be defined as someone buying real estate for their first time. But of course, the government loves to work in their little loopholes so that other Canadians just like them can spend like a failed drama teacher. And as such, the federal government and the CMHC have a different definition of first-time homebuyer. Now, before I share the definition with you, please note that each province also has their own definition of what constitutes a first-time homebuyer. So this that I am about to read to you only applies to federal programs and not things like the exemption to the property purchase tax here in BC. This is direct from CMHC's website, and I quote, "A borrower must meet one of the following criteria to be considered a first-time buyer." Notice it says one of the following, not all of the following criteria. They haven't purchased a home before. Okay, so far so good. They have recently experienced a breakdown of a marriage or common law partnership. Okay, so we're helping out the folks that have had a marriage breakup. Or they have not occupied a home as a principal place of residence that they themselves or a current spouse or common law partner owned in the last 4 years. So wait, this means that if you don't live in a property that you own over any of the last 4 years, but maybe you do own a rental property in another province, or maybe you have an entire portfolio of rentals that you have never lived in, and even though you could be a real estate tycoon, you are still considered technically to be a first-time buyer. Crazy, right? Generally, I hate the new insurance ceiling. I don't think it's a good thing. It will cause prices to go up over time. I don't hate the amortization extension for first-time buyers, but let me know what you think of these changes and this loophole down below in the comments. And know that if you're looking for real estate help here in Surrey or the Fraser Valley of BC, you can book a call with me right now using the link in the description below at a time that works best for you. Thank you for subscribing, clicking the like button. We'll see you in a couple of days.